Welcome to this special edition of Bookshelf. I'm Ryan Johnson from WorldatWork. I'm talking today with Irving Becker of the Hay Group about his new book, Understanding Executive Compensation. This was a book that was originally published a few years ago, and you've decided to update it now for 2012. Obviously a lot of activity in the executive comp space in the last few years. Let's talk specifically about why you wanted to update it and what got updated.
Well, sure. I mean, we want it to be really a helpful guide for folks, and there's been a lot of changes, as you said. One of the primary changes was Dodd-Frank, and Dodd-Frank really created the additional requirements for certain disclosure. So we wanted to include more of that type of information. One of the big things around Dodd-Frank was Say on Pay, so we've spent a good amount of time talking about Say on Pay in the book and the disclosure around Say on Pay. We also, coming out of the financial crisis, there was a lot more focus on risk in executive compensation, and so we added a chapter that talks about risk and how you can assess risk in your compensation programs. We've also added a chapter on initial public offerings. I think that market has been kind of quiet for some years, but we think as the stock market has come back, there's going to be more interest in initial public offerings, and obviously we had the Facebook one recently, so there is some activity there, and we've devoted a full chapter to that as well.
There's a concept that's been floating around in the last few months, at least the way I've been reading about it, called Realizable Pay. And I know the book touches on that a little bit. I wonder if you'd just spend a minute talking about what this idea is and maybe what some practitioners might know at a very high level that would help them.
For years, really, we've been looking at pay, when we benchmark pay, as the value at grant. So the grant value of equity awards. And that's really a pay opportunity. It's not really real pay. It's not W-2 pay. It's what you value the equity awards at grant of an award. So when companies have benchmarked compensation, it's been a little bit of, you've got salary and bonus, which are real, and then you have this kind of prediction of what the equity award would be. And what companies are doing now is they're saying, well, isn't there another way to look at this? Couldn't we look back for a few years and see what kind of compensation was realized by executives and what actually hit their W-2? And that's the concept of realized pay. And then there's the concept of realizable pay, which takes it one step further. It's not just what they've received in vested equity or in exercise stock options, but it's what they have in the money as well. So it could be grants of stock options that they haven't exercised, or it could be long-term incentives that haven't yet delivered compensation to the executives. So we had the pay opportunity as the baseline. Then companies looked at realized pay kind of as that W-2 impact for the executive. And realized pay takes it one step further and adds some of these in-the-money values as well. And I think once you have all that compensation, now you can look back over time, over the last 2-3 years, and you can say, this is what the executives really received in compensation. And here's how the company performed over that 2 or 3 years. And what that does is really gives you the best insight into a pay and performance relationship. And I think that's what the shareholders are looking for. And so we expect a lot more companies to be disclosing and reporting that type of information going forward.
Is there a single definition of realized or realizable pay? It seems like what I've been reading is that a lot of people are talking about a lot of different things in different situations.
I'm not sure there's exactly a single definition. I would say most people, when they use the term realized pay, are really looking at kind of the W-2, what actually came into income for those individuals. So it would be your salary, it would be the bonus that got paid that year, and it would be any long-term incentives that you actually received that year. So not the grants, but the realized value. So you exercised stock options and you had income. You vested in restricted stock and you had income from that. Or you got a payout under a long-term performance plan, either a performance share plan or a performance cash plan. And I think that's the definition of realized pay. And then again, to add one more factor to get to realizable pay, you would look at all the long-term incentives that you haven't yet gotten payout for, and you'd look at the in-the-money value of those awards. And I think those would be the commonly understood definitions for those two terms.
Irv, the book also touches on something called Volatility of Outcomes that I wanted to ask you about. Can you just explain that?
Sure. For years, we've been benchmarking compensation on a two-dimensional level. We look at the amount of pay that executives receive, and we look at the mix of pay. But what we've really tried to do with Volatility of Outcomes is look at a third dimension of pay, which is really projecting out your compensation package as it's designed today to try to identify what is the range of outcomes that you could possibly have for good performance, for mediocre performance, and for poor performance. And what we do is we then create some sensitivity around how volatile or how different those outcomes are. And you're able to really get insight into how risky a compensation program is. In addition to that, we're able to identify the range of outcomes, which means what's the worst case scenario for that executive and what's the best case scenario for that executive. And when you lay those out for your peer companies and you compare your compensation program to those, I think you get just another insight, more insight, a different look into those compensation programs. And I think it's just for a board level, comp committee level, reviewing that compensation program, again, it adds this third dimension to the benchmarking, which we think is very helpful.
I want to thank Irv Becker for coming in. His co-author is Bill Garrick, and they've written a new book for WorldatWork, actually revised their book for WorldatWork. It's called Understanding Executive Compensation. For this special edition of Bookshelf, I'm Ryan Johnson from WorldatWork.